Welcome to our financial management course. In today's lesson, we are going to talk about another very important investment: bonds. You may have heard of stocks where you own part of a company. Bonds are different. Instead of ownership, bonds are about lending. In this lesson, we will explore what a bond is, what it means to invest in one, what happens after you buy it, and what investors should expect, both the rewards and the risks. And as always, we will do this through a simple, real-world story. Let's begin. Imagine your friend Maya again. Her energy bar business is growing, but now she needs more money, not to start the business, but to expand it. She needs money for new equipment, better packaging, and maybe even a bigger production space. This time, instead of offering ownership, she says, "Would you be willing to lend me money? I promise to pay you back, and I will also pay you extra over time." You agree. You give her money, and she gives you a written promise. That promise is essentially a bond. A bond is simply a loan made by an investor to a borrower. The borrower could be a company like Maya's business, or even a government. When you buy a bond, you are not becoming an owner. You are becoming a lender. The borrower agrees to two things. First, they will pay you interest regularly. Second, they will return your original money at a specific date in the future. So a bond is a structured agreement. You lend money today and receive payments over time. Now, imagine that you buy a bond. From that moment on, you are entitled to receive interest payments. These payments usually come at regular intervals, such as every 6 months. This interest is often called a coupon. At the end of the bond's life, something important happens. The borrower repays the full amount you originally lent. So after buying a bond, you are essentially waiting and collecting payments. Unlike stocks, you are not watching ownership value change as much. You are focused on steady income and repayment. When investors buy bonds, they usually expect stability and predictable income. The main reward is interest. You receive regular payments simply for lending your money. At the end of the bond's term, you also expect to receive your original investment back. Compared to stocks, bonds are often seen as more stable. Investors use them to generate income and reduce overall portfolio risk. So the goal is not rapid growth, but steady and reliable returns over time. But bonds are not risk-free. One important risk is default risk. This is the risk that the borrower cannot repay the loan or fails to make interest payments. If Maya's business struggles, she might not be able to pay you back as promised. Another important risk is interest rate risk. If interest rates in the economy rise, newer bonds may offer better returns. That can make your existing bond less attractive, and its value may fall. So even though bonds are generally more stable than stocks, they still involve uncertainty. This brings us to an important idea in finance. Different investments offer different combinations of risk and reward. Stocks may offer higher potential growth but come with higher uncertainty. Bonds typically offer lower returns but more predictable income. Investors often combine both in a portfolio. Stocks for growth, bonds for stability. The goal is to create a balance that fits the investor's needs, time horizon, and tolerance for risk. So the key takeaway is this: a bond is a loan. When you invest in a bond, you are lending money in exchange for regular interest payments and the return of your original investment. Bonds can provide stability and income, but they still carry risks that investors must understand. By combining different types of investments, investors can build portfolios that balance growth and stability. Thank you for watching, and I will see you in the next lesson.